Alright, let's get straight into it. Yesterday was not a normal market pullback. There was a sea of red probably across your portfolio as well. So it was not a healthy correction. In fact, it was a structural reset that caught 99% of retail investors off guard. Why is that so? Because over the past few months, the belief of the market was that inflation was dead and that the Federal Reserve was about to give us at least 2 rate cuts this year in 2026. But now that is off the table and the Federal Reserve has just U-turned on that decision. And looking at all three of the index, the Dow Jones, the Nasdaq, and the S&P 500, you can see that all of them dropped more than 1% on the day. In fact, for this kind of move, it is actually pretty big for index. We are seeing some of them break the support like the Dow Jones. S&P is reaching that 200 EMA levels and Nasdaq is also at that support level. And so in today's video, I am going to show you exactly why yesterday's massive sell-off is fundamentally different from a standard dip that we've seen over the past few days. I am going to review the 3 massive dominoes that just fell in a single day, and more importantly, the specific indicators that you must watch before you even think about buying this dip, as well as my action plan after this. Let's start with the first domino that triggered this. So for months, Wall Street has been trying to convince us that inflation is a problem of the past, and the PPI data that just came out yesterday actually proved us wrong. So the producer price index came in significantly hotter than expected. It is a measure of cost that producers receive for their products, and it actually increased 0.7% month over month. And we actually saw the core PPI, which excludes all volatile items like food and energy. It was also up 0.5%. Now, but this headline number is not the reason why the market panicked. The terrifying part is what actually happened under the surface of the reports. So when you dig deeper into it, this is right from the excerpts of the Bureau of Labor Statistics, you can see that the final demand right over here, about 20% of the February PPI for final demand services is attributed to a 5.7% jump in prices for traveler accommodation services. So you can see that these were broad-based. This was not limited to just volatile areas like food or energy, which is expected to show up, but these are showing up in service sectors as well. And service sector, usually the inflation will particularly remain quite firm, which is usually more persistent, but this time this is actually the 3rd month where we are seeing it increase. Now what this means in plain English is that companies at the wholesale level are facing higher costs, and they still have the pricing power to pass this cost directly through the system and eventually to all of us, the consumer. So this shatters the disinflation narrative. Right? It means that inflation is going to go higher because if producer prices are running hot, it fits directly into the pipeline for core PCE, which is personal consumption expenditure. And this is the exact metric that the Federal Reserve watches closest. And now the market suddenly realized that inflation is not falling to that 2% target that the Federal Reserve aims. It is actually threatening to build a much more higher permanent floor of around 3 to 4%. And it is this realization that leads us directly into the second domino that happened yesterday as well, which is the FOMC meeting, where the Federal Reserve actually held the rates steady, but the interest rate itself is entirely irrelevant, because what was the key thing was the Federal Reserve projections ahead and Powell's tone during this press conference. Now, initially, how many rate cuts were signaled for 2026 few months ago at December's meeting? It was 2 rate cuts. But in this meeting, the Fed has just signaled only just 1 rate cut. Okay, from 2. Now it is just 1. And you know that rate cut is what the markets are looking forward to. And now instead of 2 this year, they have signaled just 1. And furthermore, they also revised their core inflation forecast higher. Right, Powell actually delivered this reality check to the market, stating explicitly that rate cuts will not happen without clear, undeniable, and sustained progress on inflations. And if that is not enough, I want you to take a look at this video where Powell even kept open the possibility of rate hikes.
The possibility, rather, that our next move might be an increase did come up at the meeting, as it did at the last meeting. The vast majority of participants don't see that as their base case. And of course, we don't take things off the table.
Now, this completely changed the reaction function of the markets because markets were basically hoping for a rescue mission after the unexpected PPI data. They were listening for Powell's words that possibly help is coming. Instead, Powell said that policy is probably going to stay uncomfortably tight and liquidity is going to remain constrained. And when we see the central bank is boxing by sticky inflation, they simply cannot provide the easy money that growth stocks need to survive. And as if sticky inflation and a trapped Federal Reserve were not enough, we just got more escalation in the US-Iran war, which you know that causing oil prices to go up, which leads to whatever that we are seeing with inflation right now. So what we are seeing now is there was a military strike on Iran's South Pass gas field, and this escalated everything. So it's not just about some shipping delays that we saw in the Strait of Hormuz. That is bad enough, but now we are talking about direct threats to upstream energy production and actual supply side destructions. Now, Iran also came back, immediately threatened to retaliate against energy infrastructure with other countries in the region, and this actually made things worse. Now, they have also announced that they have done extensive damage at Qatar's industrial site, and you can see that they were very, very prompt to attack. And right after this, just came out a few hours ago, Trump came back out and said, initially he did say that they are not going to attack Iran's gas facilities after this attack. And now he wants to blow up South Pass gas field in Iran if the strike against Qatar energy continues. So you can see that things are just getting worse. We are getting one bad news after another, and it doesn't seem to be catching a break on all three fronts. This is all reflected in Brent oil prices and WTI crude oil prices. You can see we are already above $100 and pushing back up to the $112 region. And you can saw that back on Tuesday, roughly more than a week ago, it went all the way up to 120 and it came back down. But right now, it seems that we are pushing up with sustained momentum. We are also seeing the same thing for crude oil. US oil, even though it is dropping, it is still higher than the past 2 days, and it's also pushing up towards $100 as well. So you can see the impact is flowing to oil, and as oil prices goes up higher, this is where it flows down to inflation. And now we are also talking about natural gas going up higher too. And once we saw these three dominoes line up, the reaction that we saw yesterday made perfect logical sense. There was nowhere to hide with all three coming in at once. We saw Treasury yield went all the way up to 4.27%, and this happened because bond investors had to immediately reprice for when the Fed does not cut rates. So it went up because they were pricing in for rates to actually possibly go up, to hike. And when bond yields go up, what does it mean? It means that it is more expensive to borrow. Financial conditions tighten instantly, and the cost of borrowing money becomes harder and more expensive for businesses. And this is that discount rate that analysts use in the models, the discounted cash flow valuation models and many other valuation models, to value future cash flow of corporate earnings. And when this discount rate gets higher, the valuation gets lower, which is why we saw that mispricing. And this is exactly why we saw the whole market being red yesterday, because they all rely on the promise of future cash flow. And now these cash flow are worth lesser in significantly a high interest rate environment. So we saw stocks took damage from every possible angle. Rising yields actually brought down valuations even more. And now with rate cuts being delayed with one instead of two this year, that killed liquidity hopes. And as well as that spike in energy prices, oil and natural gas, this raised the alarm for margin compression as well. And to top it all off, we did also see the US dollar surging, and a strong dollar actually sounds great until you realize that it actually affects the earnings report of multinational companies who have to convert foreign revenue back into American currency. Now, so this was not a random sell-off. It's the effect of these three-layer dominoes at once. And we are moving away from this simple disinflation story. And right now, truth of the matter is that the market is waking up to that possibility of a second inflation wave. And if we start to see growth stall while inflation stays stuck within this stubborn 3 to 4% range, and oil keeps climbing, And then we are entering that territory of stagflation. That risk is just becoming a little bit more real day by day. I'll bet it is a little bit by a little bit. And that is that absolute worst possible environment for risk assets. So, how do we move forward from here? What is the actionable? What do we have to look out for as investors, me and you? So, to me, there are three main indicators to watch. First is oil prices. And this is probably the most important short-term signal right now. What we want to watch is, does oil will continue to stay elevated above that 95 to 100 for crude oil, or Brent to be above that $100 region, which is right now, or will we start to pull back from here? Because if oil continues to hold up here, this will not be a temporary spike. It just means that energy is becoming this persistent inflation driver. But if oil starts pulling back quickly, which is directly affected by what the geopolitical events are happening right now, and that will release some of the pressure that we are seeing. Second is inflation data. Now, the key in question now is not whether inflation is falling, it is whether is inflation becoming more embedded in our day-to-day lives. So what we want to see for in the upcoming reports is that, are we still getting this hot month-over-month increase of around 0.4 to 0.5%? Because if that continues, it shows that inflation is sticky, especially in services, and that will continue to keep the Federal Reserve in a very restrictive position. But if we start to see the number at least coming down for a start to 0.2% to 0.3, that is a first signal that inflation pressure is actually easing. And third is the treasury yields, especially the 2-year yield. Now, the 2-year yield is more shorter term, and this is in a way the market's reality check. So if we see the 2-year yield keeps rising, this tells us that the market is pricing higher rates and tighter financial conditions. And typically that is not good for growth stocks. But if we see yield stabilizing or move lower, that is also a sign that pressure is in easing. So when we put it all together, it really comes down to this. If oil stays high, inflation stays hot, and yields keep rising, then this sell-off has slightly more room to go. We might test that 200 EMA or even go lower to test that previous April low, or even that previous all-time high before it came back down in April as well. But even if one of these starts to show signs of breaking, oil cooling off, inflation softening, or yield stop climbing, then we can see some stabilization in the market. But here's what I want you to remember as investors. There are three main points. The first one is, volatility like this is not a reason to panic. It is a reason to be prepared for your portfolio, because the market does not ring a bell so nicely when it's at the bottom, right? It will quietly reward the one who stay rational when everyone else is shouting, when everyone else was running scared and it was fear all around, right? We've seen this many times before. So this is the first point. The second one is, don't try to catch a falling knife. But at the same time, don't also sit paralyzed on 100% cash. So if you think back on the latest one back in April 2025, many were just saying that you'll just keep crashing and crashing and crashing, and at the same time, the same people are still out of the market because they are still in 100% cash. So this is exactly where your watch list matters, why you have your watch list in the first place. If you have been building conviction, if you have been waiting for opportunities to enter in high quality businesses with very strong balance sheet and real cash flow, and in the business of AI, which is still a long-term secular trend, moments like this are where they go on sale. So that's what you want to see. And last one is, keep your watch list ready, right? The best buying opportunities are born in moments like this. So yes, protect your capital, of course. Respect the macro shift that we are seeing now, yes. But ensure that this is ready, because this is where the best buying opportunities lie, and you don't want to be sidelined. That's all that I have for you for today's video. I hope it was really helpful for you to give you context of what is happening and what is your immediate action plan. So if you do enjoy such content, be sure to hit that like and subscribe button. If you think that this will help some of your friends or peers who are also investing, feel free to share this video with them, and this will really help me to create more of such content for you. So thank you, and I'll see you in the next one.